2025 divided investors into two groups: those who followed the hype and those who followed smart money. In this video, you'll see what actually performed in 2025, which ETFs and sectors led the market, and where the best opportunities are for 2026, 2027, and 2028. Before we start, like the video and subscribe. Here you'll learn investing ETFs and the future of money without noise, without hype. 2025 was not a year of random bets, it was a year of consolidation. Artificial intelligence moved from promise to infrastructure. Institutional capital focused on structural themes: real technology, automation, defense, energy, and healthcare. Those who tried to pick stocks struggled. Those who positioned through well-structured ETFs won. The chaos of previous years gave way to a clear focus on tangible, long-term value. The smart money wasn't chasing memes, it was building the foundations for the next decade. This shift rewarded patience and punished impulsiveness, setting the stage for what came next. Artificial intelligence was the main growth engine of markets in 2025. This wasn't a surprise, but the scale of the returns was significant. Broad AI-focused ETFs delivered average gains between 28% and 45%. That's a powerful statement about where capital was flowing. The real story, however, was in the underlying technology. Semiconductor-focused ETFs, the companies building the actual brains for this revolution, exceeded 50% returns. Let's make that practical. An investor who placed $10,000 into a broad AI ETF at the start of 2025, with an average 38% return, ended the year with approximately $13,800. No trading, no guessing, just trend plus time. It was a clear demonstration that investing in the picks and shovels of a gold rush is often more profitable than betting on any single gold miner. Now let's talk about biotechnology. Biotechnology didn't explode in 2025, and that's exactly why it matters. While AI captured all the headlines, a quieter, more strategic move was happening in biotech. ETFs in this sector posted respectable gains, somewhere between 12% and 22%. But if you looked closer at specific subsectors like metabolic therapies and gene editing, returns reached up to 35%. Historically, biotech moves in long, predictable cycles. It's not a get-rich-quick game. First, the capital positions itself, accumulating shares while prices are still reasonable. Then, the clinical trial data, the regulatory approvals, and the breakouts follow. 2025 was a positioning year. The smart money was getting in before the major catalysts, anticipating the growth that is likely to come in the years ahead. Clean energy was one of the most misunderstood sectors of 2025. It had a split personality. The first half of the year was weak, with many investors losing faith after a tough prior period. But the second half of the year told a completely different story. It was strong. The sector ultimately closed the year with solid gains between 15 and 30%. So what changed? Three things. First, the massive energy demands from new AI data centers became impossible to ignore. Second, the cost of energy storage, particularly batteries, fell significantly, making renewables more economically viable. And third, government incentives and strategic investments returned with a focus on energy independence and grid stability. This turnaround showed that deep value often appears in sectors that the market has temporarily forgotten. While retail investors were busy debating the latest trends on social media, governments were quietly signing contracts. Defense and security ETFs gained between 20 and 35% in 2025. This is a sector driven by hype. It's driven by geopolitics and national budgets. The key themes were clear: drones, advanced cybersecurity, global surveillance technologies, and military automation became top spending priorities for nations around the world. This is a perfect example of quiet capital at work. There's less day-to-day excitement, but there's a much more predictable and steady flow of large-scale contracts and long-term investment. This stability provided a powerful counterbalance to the more volatile tech sectors throughout the year. Every artificial intelligence system, every cloud service, every digital transaction depends on one thing: infrastructure. This is the bedrock of the modern economy, and in 2025, it performed exceptionally well. The sectors covering data centers, advanced chips, fiber optic networks, and corporate automation systems generated returns between 25 and 40%. Think of it as the plumbing of the digital world. This sector grows even when the hype around a specific application fades, because its growth is built on fundamental necessity. As long as we create and consume more data, the need for this digital infrastructure will continue to expand, making it one of the most durable investment themes for the long term. So let's pull it all together. Here's the clean summary of 2025's top-performing themes. AI and semiconductors were the undisputed leaders, with gains between 35 and 50%. Digital infrastructure, the backbone of the AI boom, delivered around 32%. Defense and security, powered by government spending, provided returns of about 28%. Clean energy, after a strong second half, finished with an average of 22%. And biotechnology, the slow and steady accumulator, posted around 18%. The key takeaway: diversified, theme-based ETFs outperformed most individual investors who are trying to pick winners and losers. Looking ahead, the next 2 to 3 years favor cycle investors, those who understand that different sectors lead at different times, based on current trends and capital flows. Here are some realistic annual growth projections. AI and infrastructure are likely to continue their strong performance, but at a more moderated pace of 15 to 25% per year. Biotechnology, however, is poised to enter its breakout phase, with potential returns of 18 to 30% annually. Clean energy should see steady growth between 12 and 22% as infrastructure projects accelerate, and defense is expected to provide stable returns of 10 to 18%. To put that in perspective, $10,000 invested at an average of 18% annually for 3 years becomes approximately $16,400, thanks to the power of compounding. For beginners looking to invest in 2026, simplicity wins. Forget trying to time the market or find a hidden gem. A simple, balanced allocation across these major structural trends is the most effective strategy. Consider this example: 40% in a combination of AI and digital infrastructure ETFs to capture the core tech trend, 25% in a broad market ETF like one that tracks the S&P 500 for stability. Then, add 15% for defense, 10% for biotech, and 10% for clean energy. The most important part: rebalance just once per year. Think in 3 to 5 year cycles, and learn to ignore the short-term noise. This disciplined approach is how long-term wealth is built. 2025 proved one thing: smart money follows structural trends, not fleeting headlines. If you want clarity, long-term vision, and a disciplined approach to investing, you're in the right place. Like the video, subscribe to the channel, and turn on notifications so you don't miss our future analysis. Remember, avoiding mistakes is also a powerful way to grow wealth. A happy new year of investments, and thanks for watching.